All right, and we're live.
Hi.
Hi, are you still working over there?
I am.
I thought you were done.
I'm done. I'm good.
Are you sure?
Yeah, I'm good.
Okay, so welcome everybody. Happy Saturday.
Uh-oh.
Uh-oh, you got your volume on. Okay, you're a hot mess over there this morning. You're a little out of touch, what's it, a little rusty?
I'll see. Give us a couple weeks off. This is what happens.
I know. Well, we took a couple weeks off because, A, we had to do a little traveling ourselves, and of course everybody travels around the 4th. And I was on a little business trip, so it was like back to back to back. All right, well, we'll have to skip a few of these to life happens. But so we're back in the saddle today. So
Yes.
Good morning. Welcome to Team Tuttle Realty. You're looking at our Saturday morning coffee talk. If you're first time here, welcome. So what we do is we talk about a quick snapshot of the industry here, what's going on around Oklahoma City and Oklahoma County, et cetera. Give kind of look at what the market's doing overall in general. And then we usually have a highlighted topic of the day, which can sometimes include an insider interview.
That's right. That's what we have going on this morning.
That's right. And what's the purpose of insider interviews?
To educate you guys, our viewers.
I look at it as kind of like the Wizard of Oz. When you want to lift the curtain up and you want to find out what's really happening behind the scenes, you can ask the people on the other side.
That was my favorite movie growing up.
Well, then there you go.
Yeah.
Maybe we should rename this show The Wizard of Oz Curtain Lifting.
Oh my gosh. I don't think so.
You don't think so? No. It was just an idea. So anyways, so sit back, grab yourself a cup of coffee like we have. No, we don't have hot coffee this morning.
No.
We've got our cold iced coffee here today.
It's cold brewed.
Yeah.
Homemade.
But I tell you what, that weather yesterday was pretty nice for the middle of summer. We topped out in the 80s out there across many areas of the state, which is way better than the hundreds or that sweltering 90s with heat index values around 120. That's for the birds.
It's gross.
Yeah, so out there this morning, though, it's nice. It's in the 70s. So I hope everybody has a great Saturday as you get...
It's nice and bright out there.
Get moving. Okay, so real quick here, some people are asking, well, how is the market doing? So again, our topic is about mortgage and lending, and we're going to have Kyle Robertson on here in just a second to go into more depth on this. But we always take a look at the Mortgage News Daily rates during the week, and the mortgage closed
at.
The last one was at 6.98, so it's kind of been bouncing around just under 7, just a little over 7 over the last week, but kind of settling still in that sweet spot. Now, as far as movement goes, how's it been?
It's been...
Are you awake over there?
Now you're talking about the market.
Oh, you need some more coffee. You need to pick up the pace here.
Oh my gosh. Okay, so this is for Oklahoma County.
Right.
For the week.
Yeah.
So new listings, we have 192 new listings that came to market. That's not bad.
It's a little lower than our last few lives. We're in the low mid 200s, I think.
Well, we had a really busy June. June was really busy here. So we'll see how July fares. And
overall, the market, as far as moving, buying, and selling, usually kind of peaks in June, and then in July it starts to slowly kind of taper off. And so now, as we're getting closer to August, it's probably going to get a little more.
Yeah, just depending on the person's situation. So 231 properties have sold, and 224 have had have had contracts written on them. So put those two numbers together, it still sort of outdoes all the new listings, right? So
we're still seeing
a lot of movement.
Solds in the 200s, and this is again every week.
Yeah, so pretty consistent. And again, this is only for Oklahoma County.
Right, so it's kind of like the greater Oklahoma City metro area.
Yeah.
And of course, every county has its own stats. Just kind of gives an idea of a bigger metropolitan region of how things are moving.
That's right.
And we've looked at, we watch trends across the country to kind of see how things are going.
Yeah.
I can tell you this, Oklahoma actually did pretty good when it comes to jacking up home prices that really aren't valued the way they really should be. The bigger cities got hit the hardest. We saw a list, top 30 or so. Dallas was in there, Houston, Chicago, New York City. All those really big cities, their home prices went up 25 to as much as 50% since 2020, since 2019.
I was quite shocked about that.
Yeah, so those people paid a way overinflated price for their home, and so that kind of caused some problems there, as you can imagine, because if they wanted to sell it, they can't quite get what they paid to get into the home.
That's right.
So that was kind of a movement across the country, which we did not suffer from, thank goodness. Our prices did go up a little, though, because we do have a lot of people that are moving in from out of state. And so that kind of inflated our prices.
That's right. And that's what we want. We want our home prices to keep
Yeah, so on average, they increase about 3% a year. Now, nationally, they're supposed to be right about flat to maybe 1 or 2% over the next couple of years. I think 2027, they're predicting back to around 3%, somewhere in there. Now, each person or each outfit predicts something a little bit different on those rates. But so in the big picture of things, kind of when we're looking at home movement, we look at those kind of numbers just to kind of see where we stack up. And so we're still pretty healthy overall, and things seem to be moving pretty good. So if you're, again, in that situation where I know the interest rates might shock you a little bit earlier on, but we're going to talk to the man here in a minute. It's going to calm your fears. We're talking about those. And so if you are looking to buy or sell here in the future, just make sure you reach out to us.
That's right.
So let's do it. Let's talk about our topic of the day.
Yes.
Some people say the term lending. Some people say the term mortgages. So it works. Either one is going to be what we're going to talk about. And Kyle Robertson is going to be our guest here this morning from the Mortgage Link. So we're going to bring him on this morning. There he is. Hey, Kyle.
Hey, good morning, everybody. Morning.
Good morning. So have you had your cup of coffee yet?
I've had my cup of coffee. I've had 1 bottle of water. I'm ready to go.
Good. Too much, you might leave to go to the bathroom on us. All right. So again, thanks for joining us today. Yeah. So, we thought, listen, we got to bring in the expert. And I know you kind of follow the trends and how things are going. So we've got a lot of questions kind of related to your field that either you get asked a lot, or we get asked, or everybody usually kind of wants to know. So we're just going to dive in that. But before we do that, kind of tell us a little bit about yourself, how long you've been in the business, et cetera.
Kyle Robertson. I grew up in Moore, class of 88, original Moore High School, Moore Lions. Went to Southern Nazarene, played soccer at Southern Nazarene. I've been doing mortgage lending in Oklahoma City and Edmond. This October, it'll be 20 years. I cannot imagine doing anything else. It's who I am. It's what I am. It's what I want to be known for. I want to help people buy houses.
Excellent.
I like that.
Yeah. No, that's great.
Yeah.
It's awesome.
So
you've seen a lot then.
Lots and lots. I did
20 years.
I did the subprime debacle in 2008, 9, and 10. Saw it coming starting around 2004. Yeah, just crazy times.
Right.
Okay, good. And we can't wait then to kind of get your take on how things are going now.
That's right. Yeah. So what is going on with the rates right now, and where do you see them going?
So, depending on who you listen to, what you read, most people think at least mortgage rates. There's difference between interest rates and mortgage rates. What we hear more on the news about is interest rates, and when they talk about that, they're really referring to banks lending to banks, right? The 30-year fixed mortgage or the 15, whatever mortgage you want to call it. But the mortgage industry typically follows inflation. It follows the 10-year Treasury. It follows the bond market. It's actually not too uncommon when we're in a rising interest rate environment like we've been in for the last, good grief, how long? It's not too uncommon that when they come out with the announcement that the Fed bumped up rates by a quarter or whatever they did, it's actually not too uncommon for mortgage industry rates to actually go down a little bit that day. And the reason for that is because the mortgage industry has been taking in data at the same time that all these people that are talking about rates. And by the time they make the big announcement, that's already been built into everybody's rate sheets at that point. And so when it does what it's supposed to do, the mortgage industry kind of goes, okay, that's what we expected. And then their reaction to it is, we can come off of them a little bit. I'm not saying it always happens that way, but it's not uncommon when that happens, just because that data has already been built into those rates for weeks and weeks. Yeah. I think rates have hit their high point for the year. Anytime I say that to anybody, I quickly follow that up with, I don't have a crystal ball.
Right.
So I'm spitting out what I'm being told or what I'm reading.
Right.
But yeah, they've just been kind of hovering back and forth, high 6s, low 7s for weeks and weeks and weeks now.
And that's a good point, because you're basing that off of the fact of what you already know. Right. And what you've already know, like you said, is kind of baked in. Yeah. How, and if you were to have, say, all of a sudden the country goes to war or whatever, or we got something else, some disaster, obviously that's all off the table. But that's for what's currently known, it's a good prognostic. Okay.
So should people be paying at discount points to buy down their rate in this market that we're in?
So that depends. It's going to vary from each person. That's a conversation between them and their mortgage lender.
Okay.
The rule of thumb right now is not to spend a lot of money on discount points. That doesn't mean that people aren't doing it. It's more about here's where rates are. And if you take par, which typically when you see an advertisement for here's where our rates are right now, the term is that's called par, meaning that you're not paying for the rate and there's no lender credits for the rate. That's the rate that it's supposed to be. So when we pull someone's credit, we plug in all the data, it tells us what their rate is. And at that point, the conversations today are more about, is this a comfortable payment for you for the time being? And if this is a comfortable payment, spend as little for that rate as possible. If you want the payment a little bit lower, sure, pay down the rate a little bit, but pay the discount points, get the rate and the payment to a comfortable area, right? But the more you spend in discount points right now, the longer you have to hold on to that loan to recoup the cost that you paid for the discount points. So think about it in the way of like if you weren't buying a house, if you were refinancing the house, okay? Generally speaking, if they're working with someone good, the advice would be, yes, refinancing is not a bad idea, but how long are you going to stay in this house after refinancing? Because if you're not going to stay in it for 4 or 5 years, you might not be making up the cost for that refi. So a purchase is the same way. When we think we're in an environment where rates are high and we think over the next couple, 2 or 3 years, they're going to be going down, then you spend as little on that. You just need to buy the house.
Right.
Are you comfortable with the payment? Here's where we think we're going to be in a year or 2 or 3.
Right.
Spend what you've got to spend to get the payment comfortable, but don't spend so much that I feel like I need to hold on to that longer than I should when I'm ready to take advantage of rates being down.
Okay.
Right.
Got it.
So
Yes.
yes, people are paying discount points. It's more common. I wouldn't say more common, but it's just as common now as it typically is. But they should be spending less. Don't have a rate goal. Have a payment goal.
Okay.
Right. I like that.
As we see rates going down, and again, do we know they're going to? We know they're supposed to.
Right.
Right. Inflation has gone down more than 6% in the last 13 months.
Yeah, exactly.
Across the board, it's gone down over 6% in the last 13 months. So if that trend continues, and it should, right?
Right.
The moves that the Fed is making to jack up rates, it's working. Things are doing what they're supposed to do.
Right.
So as things continue to recover, then you have a rate goal of, don't make it unrealistic because you can't catch lightning in a bottle, right? I want to get to 5. Well, we're at 5.5. Is that better? Yeah, it's better.
Right.
If it moved to 5, do you want to refinance again? Probably not.
Right.
Exactly.
Get a comfortable payment and move on down the road.
And that's what I find with a lot of the home buyers that I'm working with. They're more concerned about, well, what's my monthly payment?
Yeah.
Yeah. Now the rate is a big shocker.
It is.
Oh, good grief.
However,
we went from 2 to 3%. All of a sudden we're at 7. Everybody just went, what to do with this?
And everyone's been conditioned to that being normal.
Yes.
Exactly.
Right? Yeah. Now it's all of a sudden that 6 and 7s aren't normal. Well, god dang, 6 and 7s was normal a few years ago.
It was. Absolutely. If you go back historically.
I remember talking to my boss, Alfredo Madrid. This was right before COVID, okay? Maybe 6 months before COVID. And I remember a conversation that he and I had. And at one point, he actually said, because rates were kind of teetering in the high 5s to low 6s before COVID. And at one point it was, man, I just wish that it would just tip the barrel and get into the 6s so that the shock of it would get over so people could get back to the normalcy of, you know what I mean? It's like, so now that we're in the 7s and everybody's got all these rates in the 2 and 3s, rates just need to come down a little bit for people to go, okay, now we're back to normal again.
Right. And the funny thing is, a lot of that is psychological because when I look at I know you're a numbers guy and I'm a numbers guy. So when you compare your monthly payment on a 7% rate versus like a 6.75% rate, there's not that much different. We're only talking a few dollars. And so it's more of a mental thing to overcome than it is a financial thing to overcome.
Right. Exactly.
Okay, so when we talked about buying down the points, discount points, there's another thing people have kind of been hearing floating around And that's a 2-to-1 buy down. Can you go into what that is and if that's even a good option?
Yeah, so a 2-1 buy down in this market, I think might be a better option than buying down points. Number one, because you're spending somebody else's money, not yours. Okay, a 2-1 buy down has to be paid by the seller, and I'll just explain to you just kind of from the big broad overhead picture what a 2-1 buy down means. So you take your loan application, they plug in their data, and they say, okay, Mr. Buyer, your current rate is, and let's just say it's 7%, just because that's kind of where we're at right now. So a 2-1 buy down would be, what is the cost in prepaid interest to turn that rate from 7% into 5% for the next 12 months? The first 12 months after buying your house, your rate's based on a 5% because you've paid all that money to buy it down from 7 to 5. Okay, so you have a 5% rate for 12 months, then you have a 6% rate for 12 months, and then in that third year you get into your qualifying rate. It's not an adjustable rate mortgage, it's a 30-year fixed product.
Right.
But if you qualify it at 7, you start out at 5, then you go to 6, now you're at 7. But that feature has to be paid for with seller paid closing costs. Typically speaking, it's new construction and things like that.
Okay.
So
Not always, but typically.
did that come out of, or was that kind of in part of the idea of ARM loans where you get a different, was that completely different ballpark?
Completely different.
Okay.
Yeah,
All right. And do you see ARM loans anymore, or is that a thing of the past?
You don't see them as much as you normally would when rates are going up.
Okay.
I don't know why. Right now, just with how quickly rates have gone up, and again, I'm just kind of repeating what I've been told, but the margins are just adjustable rate mortgage products are not that great of a deal as far as rate goes right now to compare to a 30-year fixed.
Okay.
You go into an ARM because you think it's going to be a lower rate today than maybe the 30-year fixed, and for whatever reason right now that's just not the case. Most people are doing 30-year fixed or 15-year fixed or whatever.
Okay. And just for some of our viewers that might not know, an ARM, Kyle, do you want to just explain what the acronym means?
It's not these.
Right.
Or these. Adjustable rate mortgage. You go into it with a rate that's fixed for a specific period of time, and then once you go past that specific period of time, the rate goes up or down depending on what's going on with whatever variable that loan is based on. Yeah.
Okay.
It used to be
Okay, so then the standard 30 years good, and if optioned, 2-to-1 might work out as well in your favor. So when you are getting down, and of course your lender will help guide you as to what's going to save you the most money in your pocket. And once you find out what that is for you, when do you actually lock down the rate?
So some companies have different policies, and some companies have different products that allow for different things. But generally speaking, the rate lock happens once you are under contract to buy that house.
Oh, okay.
You work with your lender, you get pre-qualified. They say, based on your circumstances, here's your rate right now. You spend the next 2 weeks out shopping for houses. You are not locked in until you have a signed contract from both parties. I'm buying your house. Yes, I'm selling you my house. Here's where your rate is. When's your close date? We'll lock it in for that 30-day period, and then it's fixed forever.
So I did. So at least in the past, when I had my mortgage done, I believe the bank that I use had offered me a one-time drop if the rates had fallen during my 90-day window, whatever it was. And I'm going loosely off recollection, but during that period, I could drop one time. Is that a common practice as well?
Yeah, it is. It's called a float down option. So it's kind of like you're protecting from the, oh my God, what if? But you get the benefit of the opposite. Oh my God, what if something good happens?
Right.
Yeah.
That's true.
And then there's a margin. The rate has to go down a certain amount before you're able to take advantage of it.
Okay.
Gotcha. So I think another big one is the pre-approval versus the pre-qualified.
Yeah.
Is there a difference?
Big difference. And one of the most overused terms in the industry is I've been pre-approved.
Correct.
Most people are not pre-approved.
Okay. Correct.
most people, there's not a serious need for pre-approval. Okay.
Okay.
A pre-approval is you've given all of your information to the lender. They've passed all of that information on to the underwriter. A human underwriter verifies every piece of detail of the file. They issue the approval, and now you go buy a house. Where that's the most common is self-employed borrowers. The
Oh.
most common is we have a complicated file. We've got, tax returns on top of tax
Sure.
returns because of how a business is structured. We want to give that buyer, and more importantly, their realtor, the peace of mind of, although this is a complex file, this has been reviewed by an underwriter, and these people are ready to go find a house.
Okay.
When you have average Joe buyer, and I don't mean that in a bad way, that's just most people. Most people are W-2 employees for a company. They clock in, they clock out, or they have their salary, or for the most part, most of their pay is somewhat guaranteed as long as they show up for work. Most of those are pre-qualifications. We take their information, we verify their information with their W-2s and their pay stubs and their bank statements and their tax returns. You send that, you plug that into your operating system, right? And the approval, for the most part, is actually automated. It's an automated underwriting system that you hit the button and it says, yes, based on what you've told me, these people are pre-approved. But that term is not pre-approval, it's pre-qualified because it has not been signed off on, right? It shouldn't give buyers and realtors like uneasiness that someone's pre-qualified, as long as there's good communication between the lender and the realtor, so that the lender explains, I have verified everything.
Okay.
These people are ready to buy.
So I was going to say about the processor part.
No.
No, that's
Well,
what I was
okay.
going to ask. But you go ahead first.
Okay, so
Yep.
when you're pre-qualifying, that means you're not pulling their credit.
No, that's still a credit pull.
Oh, it
there's
is?
There's actually
Got
different
it.
types of that though. There's a hard pull, which
Okay.
is, something that's going to affect your credit. There's a pre-qualified pull where it's people would use the term a soft pull, where it doesn't hit your credit.
Okay.
A soft pull isn't going to pull from all three bureaus. Okay, it's going to pull from two out of the three. It still shows all the liabilities. You're not
Okay.
able to run like the automated approval on that soft pull. But you still see all of their numbers. I know their debt to income ratio. I know their credit scores. I know if those numbers fall in, qualifiable terms. And if everything has been reviewed, meaning I have their W-2s, I have their pay stubs, I see their bank statements, and there's no overdrafts or insufficient funds. It's one thing it goes like, here's a good example. If I plug in on, say, an online loan application that I've got $10,000 in the bank, and let's say that $10,000 is important to my approval, okay?
Okay.
So someone goes on to abcloancompany.com, I've got $10,000 in the bank, everything else about their file looks great, the loan officer hits the button, runs the approval, boom, it's approved, here's your pre-qualification letter, okay? But now somebody sends me their bank statements, and I see that $10,000 just got deposited yesterday, and it was a cash deposit, and I can't prove where that cash deposit comes from. Yes, they still have $10,000 in the bank. Yes, the automated underwriting system says they're pre-approved and ready to go. But because I'm the lender and I have the bank statements, I see the problem, I don't issue that pre-qualification until
Okay.
we get the explanation for that deposit. So it's still automated, right?
Right.
But you have the person that says, wait, that's a problem.
Got it.
A lot of times if people are working with out-of-state lenders or online companies, or there's not the conversation going back and forth between two people, they're just going off of the data that was input. Yes, you have $10,000 in the bank, you told me you have it, you're pre-approved.
Right.
So the pre-qualification in theory is, I've still reviewed everything, and I see that there are no problems based on
Okay.
what they've given me, not just what they've told me.
So in that process then of either the pre-approval or the pre-qualified, in either one, there should be no case to where your processor or underwriter comes back and goes, well, no, we can't do this, and then all of a sudden everybody's got to run around and scramble, correct?
Correct. As long as that pre-approval was not just based on the data that was input, but it's based on that I've received everything that you've told me and we've looked at it and we don't see any problems on the actual documents themselves.
Okay. So it's really it's a truth bearing
Yeah,
on
like
the
I
buyer.
work, like I work at, I don't know, it doesn't matter. I work somewhere and my salary's $50,000 a year and I get a $20,000 bonus. And when I plugged in my loan application, I said I made $70,000 a year. I've only worked there for 6 months, but I know it.
Right.
Again, that's a problem. You haven't been there for 2 years. How do we know you're going to get that bonus every year? Like all the details have to be checked off.
Okay.
Exactly.
And those details are checked off by the lender, not the processor or the underwriter. The lender gathering the documents to support what they told you to make sure there's a problem. I believe what typically happens is the conversation happens. I take their data, I plug it in, I run the approval, we kick out the pre-approval letter, they go get under contract, and then 3 weeks later, the lender's gathering bank statements, and they're like, oh, you've got, $300 of overdrafts in the last 12 months on your bank statement. That's a problem, Mr. Buyer.
Right.
And then the buyer's response to that is, well, why does that matter? I've got $10,000 in the bank.
I got
it matters.
Right?
Okay.
Like there's just layers to everything, and
Sure.
until you start peeling back the layers to find out what the problems are. So again, as long as all of the layers have been peeled back, it doesn't matter that the underwriter hasn't looked at it. If the person is competent, that I'm not just issuing the approval based on what I've been told.
Right.
I'm issuing it based on what I see.
Okay.
Got it. So a take home here is, if you talk with Kyle and he's digging deep in your personal finances, it's for your own good. Just let him do it.
I watched a podcast 2 or 3 years ago. I can't even remember who it was, but they just explained the difference between good lending and bad lending. Good lending is very uncomfortable for the first 3 or 4 days of the loan application.
Yeah.
Right.
Bad lending is it's very uncomfortable 3 or 4 days before closing.
Oh, I see that.
Think about the differences, right? When you start having all these problems before closing, my opinion is because you didn't dig deep enough quick enough.
Yes.
Right.
Yeah, absolutely.
Right? And
So
that's where those problems happen.
So true. And I mean, I used to be a banker before I got into real estate, and I did mortgages and loans, and that was the first thing that we always asked for. I need all your pay stubs, and I wanted them at that appointment.
Yeah.
So, okay, so I'm a first-time home buyer. I've never gone through the process. I'm coming to meet with you. Okay. How do I know what the best product is for me?
So, the best product, I mean, if people start talking product to you before they've taken a loan application and before they know about all your circumstances,
right,
you're literally playing darts blindfolded.
Okay.
You have to take a full loan application. You have to gather their information.
Okay.
You have to have discussions with them about what's important to them.
Okay.
And once you have all of that, the lender is, especially first-time home buyers, the lender's job is to put them into a great product. It's not just to gather their data and say, okay, you're a first-time home buyer, here's your FHA loan. It's, you're a first-time home buyer, here's all the down payment assistance products. If you don't need down payment assistance, here's the other products. What's the pros and cons of both? But yeah, there's lots of first-time home buyer programs. Work with a good lender. If you don't have a lender, talk to your realtor. Your realtor's going to know who some of the top 2 or 3 lenders are in the area.
Yep.
Trust but verify. Call that lender, interview them, ask all the right questions. If you don't know the right questions to ask, the lender should coach you through the right questions. The lender's job is to make sure that realtor's client is taken care of.
Right.
And we do that by coaching and teaching, and not just from the lender, but from both sides of the fence. The realtor, giving feedback on what the lender said, and vice versa. Yeah.
Okay. Good.
Yeah, because these different loan programs, there's different amounts of money that you put down or there's different amounts. There's closing costs. There's sometimes there's gifts. There's
Yep.
government plans. There's all kinds of stuff that's out there. So
Right.
it's not up to the buyer to have to go and learn all this stuff, because
No.
that's
Yeah.
way too much information,
Yeah.
way too complicated. So you walk them through that process, going, okay, this is what
Yeah.
you have. This
Yeah.
is where you're located. So
Yeah.
you might qualify for USDA loan. Let me tell you what
Right,
that
yeah.
is. And if it's not, you say, you
Yeah.
know what, you want the traditional FHA, we can go that
Yeah.
route. So that's where you have to be truthful to your lender and tell them everything you've got, so that they can guide you the best way to save you the most money as well.
Yeah.
Absolutely.
First time home buyers, I mean, good grief, they need to be sitting in front of people and talking.
Absolutely.
Like online things are fine, but at some point, like, you're buying a house, dude. Like,
Yes.
sit down with somebody and have a conversation. This is
Yes.
important. Yeah.
Absolutely.
So let's talk about that. We mentioned rates kind of starting off the broadcast, because everybody's talking about rates, right? That's the water cooler topic. So kind of a two-part question to that is, is it still a good time to buy with the rates where they are? And then for those that are looking at rates online, what are the common mistakes that they make while they're trying to put these two together to go forward?
So first question was, is this still a good time to buy? Basically. There's plenty of mortgage calculators. There's rent versus buy scenario calculators. There's plenty of information online that, if people do their research, regardless of rate, obviously I'm not talking about, double digit rates, but when rates are in the sixes or sevens, and then you start comparing that to comparable rents in the same market, even in a high rate environment where they are in the, even mid sevens, generally speaking, even with a rate in the mid sevens, if you can afford to buy, and even if you only plan on holding on to that house for 3 to 5 years, even with rates higher than we want them to be, it is still less money out of pocket over that 3 to 5 year period to buy a house, when you start factoring in what you're going to be able to sell it at, based on what homes in our market are increasing at per year. So yeah, it's still a good time to buy. It doesn't feel good.
Right.
Rates aren't where we want them to be, but yeah, it's still a good time to buy. Second part of the question, remind me of that one.
Yes, whatever. What kind of mistakes can they make when they're looking at rates online?
So really, it really comes down to just knowing how to read the disclosures and knowing where the fine print is about the discount points. Most mortgage companies, when they publish those rates online that you see, in the fine print somewhere, it will show you what you're paying to get that. Okay. So I would just encourage anybody, if you're looking at a rate online, okay, and then you call your bank, or a local mortgage lender that you've been told to call, okay, if there's a big spread between those two, you should start digging, because there should not be that big of a difference, right? We're all lending from the same bucket of money.
Right.
Within reason. Different companies have different margins, so the costs are going to be a little bit different from one place to the next. But man, if you're on abc.com mortgage company, and it's showing you a 5.5 rate, and you call your mortgage lender down the street and their rate's at 6.875, let's do some digging before we jump headfirst into that lower rate, because you might not be getting what you pay for.
Okay.
Good point.
You
Yeah.
just have to be careful.
Sure.
Have somebody explain to you how to read it and where the discount points are, and that kind of thing. Yeah.
Absolutely. So another thing is refinancing. So when should someone maybe refinance, or I guess take equity out of their property?
So that's two different questions. If somebody needs equity, they need equity. Sometimes they don't necessarily need equity, but they want to do debt consolidation.
Right.
You might have your 2 or 3 or 4% mortgage over here, but what if you've got $30,000 in credit card debt that's at 23% interest that you're never going to get out from under? When you've got a ton of equity in your home and you want to consolidate all that debt, even if it's in the 6% mortgage or the 7% mortgage, what if doing that refinance saves you $400 a month?
Absolutely.
Right? Like, what if doing that refinance and creating that higher rate frees up, all of this money over here to make life more comfortable? So a refinance is, again, that's just based on circumstances.
Okay.
There's lots of reasons to refinance in a high rate environment. There's a lot of reasons, obviously, to do it in a low rate environment. Most people, the biggest mistake that most people make when it comes to refinancing is trying to time the market. Like,
Oh,
I
okay.
think rates are going to drop another point. Well, again, it goes back to what I said about buying a house right now. Is the payment comfortable? Are
Exactly.
you, are you
Okay.
saving money? Are you hitting a goal? Like,
Yes.
you're going to wait another 6 months. What if they start, what if something happens, and now
Right.
the plan's gone? Get to where that's comfortable. I'm happy with that. Move on down the road. If they continue to do it for another 2 or 3 years, maybe you do it again. But again, it's a math problem,
Right.
right?
It
Just
is.
do the math.
Okay, so that's a good point because some people are putting themselves in a kind of a tough spot in hopes on a wing and a prayer
Yes.
that the rates will go down like five
Yeah,
nine or something,
yeah.
next year, and then they'll
And
refinance and everything's
right.
good.
But so rates go down a point over the next year, but that home that you wanted to buy went up 4.5% in price,
Right.
Right.
right? Like,
Exactly.
Yeah.
it still cost you money not to buy that house.
Exactly.
So, and I know in some banks or in some cases, sometimes there's some leeway either on a discounted or maybe sometimes there's specials, but when you do refinance, it's not always free to do that process because it does cost time and
Yeah,
paperwork on both ends.
yeah,
But I'm assuming that sometimes you can get a little bit of a deal because you're sticking with the same bank, maybe, for
yeah,
example.
yeah.
Okay.
Across the board, I mean, the general statement is it costs the same to refinance as to buy. Okay.
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 However, if you go back to your lender, will they do a free appraisal?
Ah. Okay.
Just
Sure.
what are they going to do to incentivize you to use them again?
Right.
Sometimes it's just the relationship and the rate, you know,
Exactly.
but there should be some incentive. They're
Okay.
Right.
make them earn your business. Good grief.
Oh yeah.
Sure.
Yeah,
That's
Exactly.
right.
Make them squirm
yeah,
a little.
yeah.
Isn't that the
Just a little.
same date the rate, marry the
Mar-
house?
marry the house, date the rate. Yeah.
Yeah.
I hate that phrase.
Right. I've heard it, and I'm like,
I'm so
okay.
tired of hearing. The only time you hear that is when rates are too high.
Oh my gosh.
That's right.
Ain't nobody saying that about a 4% mortgage.
Oh
Oh
no, not at all.
no, 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 no.
Okay, so we've been talking about how obviously things are a little higher than they were, and
Yeah.
the shock value is kind of wearing off. But if you still got to get into a home, it's still going to cost you some money. So what kind of programs are available for down payment assistance? Whenever, maybe especially for first time home buyers,
Lots of good programs. There's still bond money in different counties. I mean, bond money is free. There's income restrictions for it. There's usually location restrictions for it. Oklahoma Housing Finance Authority has lots of good down payment assistance programs right now. The different down payment assistance programs kind of vary a little bit in how they work. Some of them are you can get the money without, and when I say get the money, I'm referring to the down payment assistance, not the loan. You can get the money without a rate associated with it, so there's no monthly payment. But when you sell the house or refinance the house, the money has to be given back. Okay.
Okay.
But I've kind of come up with a phrase for that I call it a free loan. Like they're going to give you the money and you have to give it back to them when you're done with it.
Right.
Right. All right.
Okay.
Right. And then there's other programs similar, but they come with a monthly payment. Some of them are fully forgivable. That's a harder thing to get right now, just because of how the money's created. Generally speaking, yes, down payment assistance is available. They don't give you 100% of the down payment. So I'll just give you an example. So like on an FHA loan, for example, FHA loan, the minimum down payment is 3.5%. Okay. So if you subtract that 3.5% down payment from your purchase price, that gives you your loan amount. Okay. Then you add in the upfront private mortgage insurance to your loan amount to give you what's called the total loan amount. Then you take that total loan amount, multiply that times 3.5%, and that's how much down payment assistance you receive. So there's always going to be a little bit of a margin. Like the way I like to explain it is, they still want to see that you have some skin in the game. It might only be a couple $100,
right,
but you have some skin in the game.
Okay.
And then the rest of your skin is your closing costs and your prepaid items. So the money that they're giving you is to go towards the down payment, and they're giving you about 99% of that down payment.
Okay.
So one thing that we've discussed in all of this, and this is probably what scares people off the most, is, but Kyle, I don't have good credit.
Yes.
Yeah, can you address the whole credit issue and all that?
We pull more, I wouldn't say more, we pull way more bad credit files than you would think. Okay? And when someone comes to their realtor and says, I can't buy a house, but I want to buy a house, I'm working on my credit, you need to talk to a lender. Don't do credit repair by yourself. You're gonna do some research online. You're gonna misunderstand something or misinterpret it. And what if you make a mistake that costs you buying that house? If you don't have good credit, you need to talk to a mortgage lender. Let them coach you on what's the best route to get your scores where they need to be the quickest, so that you can become a buyer, and just get the coaching that not everybody has perfect credit. Heck, nobody has perfect credit. Like, there's something wrong with everyone's. Talk to your lender so that they can coach you, so that they can not just coach you to get your scores up, but coach you to a qualifiable program.
Got it.
Yeah, just get the coaching. Talk to them.
Because that's what I hear a lot.
Yeah.
So
And there obviously there is a threshold that you have to at least achieve. It's kind of like, when you get in the grades in school, you got to get at least a D. So what's the D ballpark? For credit scores, what you're trying to aim to when it comes to repairing your credit.
I mean, there's that's such a loaded question.
Is it still loaded?
way to go.
Yeah.
I would say the goal is. I mean, you don't want to ever coach people to the minimums, but the minimum goal, you really want to get your credit score above a 640, especially if it's for an FHA down payment assistance. Okay. Can you get a loan below a 640 credit score? Absolutely. Different lenders have different minimum tiers.
Okay.
Right.
Some of them will tell you 620, some of them will tell you 600, some of them will tell you 580. Heck, FHA has a no credit score. I mean, you can have no credit and get a loan. Okay. It's not easy, because then it's considered a manual underwrite, and then the underwriter can ask you for anything they possibly want to verify that it's a good deal for you.
Right.
Sure.
But technically speaking, there's not a minimum credit score. The lender might have one, right?
Got it.
Right.
Yes.
So it's just, above 640 gets you qualified for most down payment assistance programs.
Okay.
Not all of them, but most of them. There's other qualifying numbers. The debt to income ratio cannot be too high.
Right.
There's income limits to down payment assistance. You can't make too much money. And then there's other programs that aren't really considered down payment assistance. Aaron brought it up just a second ago with like USDA. USDA is 100% financing as well.
Right.
It's got minimum credit scores similar to FHA loans. Like, there's lots of programs out there. It's just making the phone call and talking to somebody so that they can make you aware of them.
Good. Okay.
Very
Wonderful.
good.
Yeah.
Man, Kyle, hey, this has been great. We went really long this morning.
I feel like that was a 5-minute answer to a 30-second question.
Oh no! The more information, the better.
No, because no one ever talks about mortgages or lending until they're faced with buying a home, and all of a sudden they got to drink out of a fire hose to learn this whole process and all these numbers and the credit and everything else.
And I mean, something that we didn't touch on was where you talked about people that have bad credit. But what about the people that are younger, still want to buy a house, but they haven't even started building credit? They have no credit. So there's those out there too.
And when they don't have any credit, especially when they get up into their late 20s, early 30s, like, those people still don't have any credit. Like, that's a mindset. I mean, you have no idea how many people we talk to that say, well, we follow the Dave Ramsey theory.
Oh, okay.
I mean, he teaches you not to have credit.
Right.
So and that's okay. Okay. But there are still certain things you need to do to buy a house.
Right.
Like, you want to play by the rules and you want it to be the easiest process as possible. If you're in your early 20s and you don't have any credit, again, call a lender. Let them coach you. They're going to tell you how to get a credit card.
Yep.
They're going to tell you a good credit card. They're going to teach you how to use that credit card. It's one thing to have the credit card. It's a whole nother thing to use it the right way so that you get the maximum benefit from it.
Absolutely.
Right.
And
And that's the frustrating part, even for me, because I have this endorphin release where I feel good when I've paid off a loan, and I want to pay it off early. But then the credit card, the credit agencies look at it and says, "Oh no, you paid that off in 12 months instead of 60, so now you just lost 40 points." I'm like, that's bogus, man.
And in your mind, you're like doing this touchdown dance. I paid off my loan. And then you go into the bank and they're like, "Score it, sir. Your score went down 20 points." You're like,
Right.
Why? Because you closed an account. And you're like, that's the dumbest thing I've ever heard.
Yes.
Yeah.
Yes.
Yeah.
It's a racket.
And yes,
Right.
I think it's the dumbest thing ever too. But I don't make the rules.
Right.
right.
Got to know how to play the game.
So yeah, for those that that aren't familiar with the credit world, the key is to always make payments on time, make at least the minimum required, and a long period of time for payments, and don't go and close off everything you get once you pay it off. Leave it all open, and let them keep adding credit to that line. In other words, they'll once gave you $1,000 credit, now they give you $2,000. You say, "Great, thanks," because all you did was increase my credit.
If somebody ever asks you if you want to bump up your credit line on a credit card, you bump it up.
Yep.
Wow.
That doesn't mean that you use it more.
Right.
So that doesn't
you want that spread.
So that doesn't take away from your debt to income ratio, your debt to service, no?
When you're using it more?
No, if you have all this available credit, it doesn't affect your debt income ratio.
Well, normally they won't increase it unless they see that you've got a better income.
Right.
Yeah. Like they won't give a 21-year-old a $100,000 credit line.
Well, no.
But
they're increasing the
that.
limit. But what affects the debt ratio is how much you use compared to the limit.
Oh.
Right.
Okay.
So if somebody has no credit scores and they go out and they get here's a typical scenario. I don't have any credit. I can't even get a credit card, so I have to get like what I'd call a subprime card. They're going to charge you an annual fee for it, right? You get this brand new credit card. I've never had a credit card before. They're going to give you a $300 credit limit. You need to go spend $30 on gas.
Right.
You need to make a minimum payment for a month or so. Pay that thing off. Go buy another tank of gas for $30. Like if you have not had credit, you need to use it in little bitty bits and pieces. Just show because what you're really doing is you're showing discipline.
Right? And that's what they want.
What does a lender want to see? They want to see discipline. They want to see that you have the ability to obtain debt and pay it back when you're supposed to.
Right. Okay.
And not overuse it.
Right. Keyword.
Just because you have a $10,000 American Express card doesn't mean that your balance needs to be $9,999.
Right. Absolutely. Okay. Good. Then well, thank you.
Yeah.
Okay. So.
Yeah, that was great. Yeah. So, Kyle, man, where can people find you? Because this has been great interviews.
It's been wonderful.
The easiest way to find me is just teamkyle.us, www.teamkyle.us. Best way to get a hold of me is my cell phone.
Okay. And there's your contact information.
Contact information there. And
yes, absolutely. This has been really good. Thank you.
And of course, if you go back and you can play this back to write it down. If not, you can always just reach out to us as well as Team Tuttle Realty. We'll get you into contact with Kyle. And we just did that with someone yesterday. Matter of fact, they reached out and they wanted to buy a home out in Weatherford, and they said, "All right, let's get in there with Kyle. Let's see how the pre-approval / pre-qualified process get you going in that direction."
Yeah. That's right.
So
That's good. Well, thanks, Kyle, for your time.
Absolutely. This was a good time. I really appreciate you guys having me on.
You bet. Thank you, Kyle. Have a good rest of your weekend.
Hey, everybody, have a great weekend.
Okay, take care, man.
Thank you.
See you guys. Bye.
Bye.
All right. So, hey, that was a great interview.
Yeah, I learned a lot.
Yeah. Kyle's on it, man. That's
good.
It's like, I tell you what, it's like drinking out of a fire hose. There's so much information sometimes.
There is.
So that's why we have these insider interviews, because we want to know, just like you guys do, all the ins and outs of the industry that's going to affect you
Yes.
and your pocketbook, because you want to be well informed. We want to be well informed, and it helps everybody, helps the process go more smoothly. That way you feel like you're not being taken advantage of, and you're guided the right way.
Oh, and that's it. That's it. You're putting a lot of trust into a lot of people
You
when you're
are.
buying a house.
Yeah,
So,
I still remember the first time I bought mine. I didn't know nothing about nothing, and I'm just whatever somebody says to do, I say okay, and I say wherever you put your signature, I go okay, and I could have been taken advantage of 10 different ways from Sunday. Would have never known.
And that's why I got into real estate. When I left the lending part of it, went into real estate because of my home experience for buying. I'm like, I can make this different. I can make this better. And it's all about educating.
Yeah, for sure. And that's what we're going to do here at Team Tuttle Realty. We're going to
That's
continue to
right.
educate you so that you are familiar with all parts in the real estate transaction when it comes to buying and owning a home or land or anything else.
Absolutely.
We have more interviews lined up. One of the ones we have scheduled coming up soon is something you never hear anything about
Right.
until this magical word of close comes up. And I'm
Closing.
like, I don't know what close means, but we're going to go close. And then
Yeah.
that is where you meet your title company.
That's right.
So we're going to interview Legacy Title coming up here in a couple weekends, and we're going to talk about the title process and what that means and how they handle your funds. Because believe it or not, they're like the third-party facilitator for how money is transacted, how everything's on the up and up. So that's how they make sure you don't get taken advantage of.
And all the documents that you're signing at closing.
So many documents.
So many documents. So
Anyway.
it's good.
All right. Hey, you guys have a great rest of your weekend. If you're watching the replay, also thank you again for watching that. And make sure you like and share Team Tuttle Realty on
Yep.
all the social media accounts. And in these interviews, be sure to share them with your friends and family.
That's right. Agreed.
Anything else?
Oh, little Penelope.
How about
Okay.
one little, because Penelope's about to turn 1 year old. So we'll give you one little peek here of Sleepyhead. And
Oh, boy.
yeah,
There she is.
there she is, Miss America.
Yeah.
So I don't know if you were watching us at the beginning about a year ago when we got Penelope.
Right.
You remembered how dark she was. She was a dark little poof ball, and so now all of her hair is transitioned over. So now she's a sleek silver fox, or who you like to call
Well, Rocket.
Rocket
She looks like Rocket
from
from Galaxy of the
Guardians of the Galaxy.
Guardians of the Galaxy.
Yeah, we watched that movie the other day, and you're like, "Hey, Rocket looks like Penelope."
Yeah. Rocket.
So we've got a little raccoon in our hands.
That's right.
Yeah. So anyway,
cute. Anyways.
Yes. So that's it for us. We'll see you on the next broadcast. Take care, everybody.
Bye-bye.
Morning coffee, vanilla latte served to go. I drink it slow. Morning coffee, cappuccino.